Hello, good afternoon. Thanks for tuning in again. The response to my first video was overwhelmingly positive, and I can't tell you how much I appreciate the support, and it sounds like I've helped a few people. So with that, I'm going to take some of the questions that I've gotten from that first video and expound upon some of the information in there. Go into a little fund overview between all the different G, C, S, I, and F funds, and also the difference between Roth and traditional contributions. Quickly, we'll start off with the difference between Roth and traditional contributions. The traditional contributions come out before taxes. That means that you get your paycheck, that money immediately comes out off the top, and then taxes come out. That money will grow tax deferred. However, when you start taking your distributions, 59.5, or whenever you so choose to begin taking your distributions after that age, you will pay taxes on that money. For the Roth option, if you put that money in, taxes are taken out of your pay first, and then 10%, 15%, however much you have coming out of your monthly pay will get sent to TSP. So the dollar amount's the same, the effect on your paycheck is completely different. One lowers your taxable income now. The Roth option hopefully lowers your taxable income when you are in retirement age. For military, I feel that the Roth is the better option because our pension payment is going to be taxable income. So if your TSP payments also were taxable coming out of a traditional option, you would be paying taxes on both your income coming in off of your pension and also the income coming out from what you've saved through your TSP distributions. The Roth option should effectively lower your taxable income in your retirement years. That's why I feel the Roth is the better option. The TSP Roth has been around for a few years. If you haven't switched your money, your contributions to the Roth, it's really easy to do through the DFAS website. If you've got a whole bunch of money in the traditional, that's awesome. I'm in that boat too. I've got a bunch of money in the traditional option. My current contributions are going to the Roth. You'll just have some tax-free growth and some taxable growth. You potentially could roll your money out of TSP, and then you could roll that into a Roth option after your military career is over, and you would have to pay the taxes on that money, but you could roll it into a Roth option, and then from that day forward, it would grow tax-free, but you would have to pay those taxes. Now, what's the difference between all the different funds? The G fund, that's your government securities. There's no risk at all on there. That fund currently averages about 2% a year, give or take. Right now, since inception, it gains 5%, and the 10-year average 2.5%, 2.3 to be exact. That's basically just meeting inflation. There's no risk of losing your money, but there's also very little to no growth on your money. Unless you're in retirement and you're trying to preserve a whole bunch of your capital, you should get out of that G fund as soon as you can. The F fund is your government corporate mortgage-backed bonds. This matches the performance of the Bloomberg U.S. Aggregate Bond Index. Low risk. Right now it's averaging for the 10-year 3.73%. And since inception, it's 6%. So since inception, it includes the really bad years of 2007, 2008. 10-year average does not include that time period. The C fund, it's the stock of the large and medium U.S. companies. It's basically your S&P 500. It's going to mirror what the S&P 500 does. Historically, 10% for the whole life of the C fund. That's going back to 1988. It's averaged 10.01%. 10-year average is 13.17%. So people say, how do you get these 10% numbers? The C fund, 13% in the last 10 years, 10% for its lifetime. The S fund is your small to medium U.S. companies that are not included in the C fund. It basically matches the Dow Jones index, which is a moderate to high risk. 10-year average is 13.67%. Since inception in 2001, you're looking at an 8.21% annual average rate of return. So between the C fund and the S fund, it's very easy to get to the 10%. Lastly, the I fund. The I fund is all of your international stocks. It's going to match the Europe, Australia, and Far East index. Moderate to high risk, 10-year average rate of return 6.48%. Since its inception in 2001, it's 4.09%. All of this information is found on the TSP website, tsp.gov. I'll link to it also in the video. Then the life cycle funds. The life cycle funds are a mix of all 5 TSP funds targeted on a retirement date. These funds start out more aggressive with the bulk in the C fund, and then they move to more conservative, and at that target date, 2020, 2030, 2040, 2050, it's extremely conservative, mostly preserving capital in the G fund. My opinion is that at retirement age, 59 and a half, you don't need all of your money right then. You're going to want to have some distributions coming out, but you don't need all of your nest egg on that one day. You want to leave some of it invested. So it's my opinion that the life cycle funds are too conservative when it comes to retirement time. They basically very conservative to ensure that you have payouts, but you should still, at 60 years old, you need 10-year, 20-year, and hopefully 30-year money if you live to 90. And the only way that you're going to have enough money to live and continuously get money during that time period is if you're still invested. Quickly, the 10-year averages of the 2020 fund is 7.62, 2030 is 8.91, 2040 is 9.81, and the 2050 hasn't been around for 10 years, so its 5-year average is 5.33%. So you can beat what these life cycle funds are doing if you invest your money in the C fund or the S. My beliefs, the Roth option's better than the traditional because it'll lower your taxable income in retirement. Your Roth payments, they're tax-free at 59 and a half. So that's a big benefit. The difference is that you will see a higher decrease in your paycheck when you select the Roth option now. You need to get your money out of the G fund as fast as possible. Putting it anywhere is better than it being in the G fund. Every single other fund beats what the G fund does, so you really can't go wrong. My opinion, I feel that the core of your investment, anywhere from 50 to 80% of your investment, should be in the C fund. The remainder should be split between the S and the I funds. I am not a big fan of the F fund. Everyone's financial goals are different. So how I invest my money isn't necessarily how you should invest your money. So I don't want you to take this as the best option. It is just a option. Me personally, I have 80% in the C fund, 10% in the S, 10% in the I. And then what I do is once a year, every year, I rebalance those funds. So if the C fund's at 82% of my total portfolio and the S fund is at 9% and the I fund's at 9%, I'll reallocate that to 80-10-10. And what you've done there, you've effectively sold high and bought low. You've bought the S and the I fund at a lower cost and you've sold the C fund at a higher cost. Hopefully, as stuff continues to grow, this just makes you more and more money. Rebalance once a year. Probably not worth it to do more than once a year. Then once you determine how you want to break down your funds, you need to change your future allocations to match that fund breakdown. So you don't want to move your money, do an interfund transfer and move your money to the CS&I or the CNS or whatever you choose to do, and then leave your monthly contributions still going to just the G fund. You need to make sure that your monthly contributions are also set up 80-10-10, 70-15-15, however you break it down, 60-20-20, so that your contributions match the allocation that you have set up. I hope this helps. Again, the way I invest isn't necessarily the way that you should invest your money. I hope this gives you a little bit better idea of what all the different funds are and how they perform. Quick rundown again: G fund, government securities. F fund is your bonds. C fund matches the S&P 500. It's your 500 largest companies in America. S fund, small to medium companies that are not part of the S&P 500. Lastly, the I fund, which is your international stocks. Thank you for tuning in. Again, if you found some good information from this, subscribe to my channel. I plan to continue to do more about TSP and other military pays and benefits. Again, hope this helps. Subscribe to my channel, share the video. Hope you learned something.